Holistaplan presents Tax Time with Jeff Levine. Let's talk taxes.
Hey everyone, Jeff Levine here, and it is awesome to be back with you. With our time today, I thought we'd address a question that comes up quite frequently from advisors, which is how does ordinary income and capital gain income interact with one another? Or when we're looking at the tax rates and tax brackets and trying to figure out what adding more income will do, does the ordinary income kind of have its own system and capital gains have a completely separate system? Like, how does this work? So, in short, ordinary income comes first. And we look at ordinary income and just kind of compare it to the brackets as it is. So, if we are talking about an individual with $200,000 of ordinary income, well, a portion of that will be taxed at 10% in the brackets for their particular filing status. A portion will be taxed at 12%, a portion at 22%, etc. But that's a little bit different than long-term capital gain income, because long-term capital gain income actually gets added on to the ordinary income. It's taxed at long-term capital gains rates, but when we're looking at the long-term capital gains brackets, we don't start at $0 for long-term capital gains unless somebody has no ordinary income. As an example here, let's say an individual had $100,000 of ordinary income. When we're looking at figuring out what sort of capital gains rate they are subject to, we look at the bracket for $100,001 with their first dollar of capital gains, not $1, $100,001. We have to count their ordinary income first and then layer on the capital gain income. And believe it or not, this can create some really unexpected spikes in marginal rates that are well in excess of both the stated ordinary income tax bracket as well as the capital gains income bracket that you might otherwise expect income to fall into. And a common place where we see this is at the upper end of, let's say, the 12% ordinary income tax rate, as individuals sometimes pull in more and more income at that 12% marginal rate. They may end up kicking some of their long-term capital gains more certainly than they had before, bringing in more income, let's say via a Roth conversion or a bonus or just having higher business income, whatever you want to call it. We can find scenarios where they have more of their long-term capital gains now taxed at the 15% rate than they had at the 0% rate. Notably, long-term capital gains bracket is 0% until a client is out of the 12% ordinary income tax rate. They roughly align with one another. So what happens is, as you add income towards the end of that 12% bracket, sometimes you not only get income taxed at that 12% rate, but you kick other income that was taxed at 0 up to 15%. So you effectively have yourself a 27% rate. Now, if this sounds a little bit complicated in words, it's even more difficult to explain to clients without clear visuals, without going through a process, and without software. And so with that in mind, I want to turn this over to my good friend Ben Birkin to take us through how Holistaplan can help advisors spot these sorts of spikes and easily present it to clients in a way that helps the clients know that the advisor is looking out for them and making sure we are minimizing their tax bill over the long term, which is always the most important tax bill to minimize. Ben?
Thank you, Jeff. This is Ben Birkin, Vice President of Client Success and Engagement at Holistaplan, and we're going to spend the next couple of minutes talking about how Holistaplan can help you visualize the concepts that Jeff just talked about in terms of differentiating between ordinary income and investment income and how that relates to taxes. There are two different ways that you can look at this within the Holistaplan system. The first is a summary of what happened last year. So using the tax report to break down that distinction. And I've got a sample tax report up here, where if we look at this particular client situation, they had total income of a little over $55,000, deductions of about $27,000. That broke their taxable income down to about $27,676. Holistaplan will, behind the scenes, separate out how much of that taxable income is ordinary income and how much of it is investment income, and then give you the marginal rates for each type of income. So in this particular case, because deductions work off of ordinary income first, like Jeff talked about in that stackable exercise, the deductions here were such that it wiped away all of the ordinary income, so that there was no ordinary income in this particular case. Had there been any, we show you the thresholds for the 10, 12, 22% brackets and so on, and we'll highlight which bracket your client fell into for that amount of ordinary income. Down below that, we show the marginal brackets for the investment related income, so long-term capital gains and qualified dividends, which get the preferential tax treatment. In this particular case, all of the remaining income qualified for that preferential treatment. Tell you how much it was, 27,676, and where the taxpayer shows up in those taxable income thresholds that Jeff talked about. Now, the thresholds don't exactly line up with the 12% bracket, but it's pretty close. So in this case, the married filing joint couple, they had 27,676 of qualified income. That all got taxed at a 0% rate. So their total tax on all of this income was $0. It's a pretty good deal, right? $55,000 of income and no taxes on it. So this is backwards looking though. And so you might be thinking about, okay, if this situation is going to be similar next year, how might I make take advantage of that? So within the scenario analysis tool, I've got a scenario in here for same client going forward. The only difference between last year and this year would be maybe this year they have to start taking required minimum distributions from their IRAs. So they're at about a $25,000 IRA distribution. We can scroll down and see now we've got total income of about $86,000. Same sort of schedule of deductions and everything going on down here. So we get a taxable income of about $58,000, a little bit more than that, which would still put them in the 12% marginal bracket. So a little bit higher than last year because of the IRA distribution, but still pretty cheap. If you just looked at this at first glance, you might say, well, I know that the end of that bracket goes all the way up to $80,000 of taxable income. I've got a lot of room to work with for a pretty cheap Roth IRA conversion, right? I can convert maybe $20,000, $30,000 and only have to pay a 12% rate on it. But, and this is where it gets important to remember, there are capital gains to think about. We've got another system in here where we say, okay, there are $16,000 of net long-term capital gains. That becomes important when you look at the range calc feature, and you can see here that yes, while you might have a significant amount of money to go to get to the $80,000 or so threshold where the next bracket kicks in, you only can go through half of that before you reach the spot where you're now pushing some of those capital gains into the 15% bracket. So that actually occurs at about $23,000 of additional ordinary income. You start displacing some of those capital gains and qualified dividends that we're experiencing a 0% rate, now get a 15% rate. And so the next dollar has that combined 12% rate on ordinary income plus 15% on capital gains income. That gets you to that 27% rate that Jeff was alluding to when he was speaking just a couple of minutes ago. So we hope this is a good visual representation of this concept. We want you to be able to talk about this in a clear and cohesive way with your clients and be able to describe it with visuals instead of words, because we know visuals can paint a more compelling picture. Thank you so much for watching. We hope you continue to get a lot out of the Holistic Plan system and continue to serve your clients and be a tax planning hero. Take care.